right. So, we've all heard it right. This idea that higher growth always leads to higher value.
Uh-huh.
But is that really the case? I mean, is it really that simple? I think you and I both know it's probably not.
Right. Yeah. It's a bit more complicated than that, isn't it?
Yeah. So we're going to try to really dig deep into that today.
Yeah, that phrase gets thrown around a lot, and I think particularly in the investing world, but there's a lot more to it.
Yeah.
It's not just growing for the sake of growing. It's understanding how a company grows and whether that growth actually translates into something tangible, something sustainable.
Okay, so let's break this down.
Yeah.
When we talk about a company's value, where do we even begin? Like, how do we even start to think about that?
Well, I think the core concept to understand here is the present value of future cash flows. So you can imagine a company as a money-making machine, right?
Yeah.
And the value of that company at its most fundamental level is the sum of all the cash that it's expected to generate in the future. But we have to bring it back to today's dollars. Because a dollar today is worth more than a dollar tomorrow.
Absolutely makes sense.
So that's sort of our starting point. And then growth is kind of like a booster shot for those future cash flows, right? So
yeah, it's like like you're multiplying those future cash flows.
Growth acts as a multiplier. So when a company grows, ideally it generates more revenue and more profit, which directly increases those future cash flow projections. But there's another layer to this.
Yeah.
A significant chunk of a company's value is tied to its longer-term potential, and we call that terminal value.
Okay.
And so this is where the growth assumptions become really crucial, because a higher projected growth rate in the future can lead to a much higher estimate of that terminal value.
Okay, that's helpful.
Yeah.
Can you give me like a real-world example of how this terminal value kind of plays out?
Think about Tesla, right? Even though their profitability has been kind of inconsistent over the years.
Yeah. Their stock price has absolutely soared.
Yeah, they've had huge growth.
And that's because investors are essentially betting on their future potential to dominate the electric vehicle market, right?
Okay.
So that future potential, that belief in their long-term growth is baked into their current valuation, even if their current profits don't fully justify it.
That makes a lot of sense. So we've got this idea of growth boosting both the immediate cash flows and then this longer-term terminal value based on future potential. But I'm guessing it's not always that straightforward.
You're right.
Right.
Just because a company is growing doesn't automatically mean it's creating value. So let's maybe look at some examples to kind of illustrate
let's do it.
The complexities of this relationship.
Yeah.
So let's start with a classic success story. Amazon.
Okay.
Right. In their early days, they basically reinvested every dollar back into expanding their operations, building warehouses, developing their cloud infrastructure.
They weren't fixated on immediate profits. It was all about that long-term strategic growth.
Right. And it obviously paid off huge for them.
Yeah.
But what about some cases where the growth didn't lead to that kind of fairy tale ending?
Well, remember WeWork?
Oh, yeah.
They were expanding aggressively, gobbling up office space all over the world. And on paper, the numbers looked impressive, more locations, more members, but their underlying business model was really flawed.
So we all saw how that played out. That's a big cautionary tale.
It is.
What went wrong there? I mean, did they just grow too fast, or was there something else going on?
I think that rapid expansion kind of masked some deeper issues. Their costs were skyrocketing.
I see.
While revenue struggled to keep up, and it led to massive losses. And when they tried to go public, investors saw through the facade, and their valuation plummeted. It's a really stark example of how growth without a solid foundation, without a sustainable plan for profitability, can actually destroy value rather than create it.
So it's not just about growth, it's about the quality of that growth.
Exactly.
How sustainable it is, how profitable it is.
And even when a company is experiencing seemingly positive growth, there can be red flags.
Okay.
For example, growth without profitability
like Uber
can be a major concern.
Right. They've grown like crazy, but still haven't been able to really turn a consistent profit.
Right. And that's the million-dollar question, right? Is that kind of growth truly sustainable? Sometimes rapid expansion can obscure underlying problems with a company's business model or its ability to control costs.
Yeah.
So investors really need to look beyond just the revenue growth and scrutinize whether a company's growth is actually translating into profits.
Yeah, that makes sense.
Another potential pitfall is when you have a company whose growth kind of gets ahead of its ability to manage it effectively. A good example of this is Peloton during the pandemic.
Oh, yeah.
They just couldn't scale their operations fast enough to deal with that sudden surge in demand.
Peloton.
Yeah.
Yeah, what happened there? Like, what were some of the specific...
Well, they ran into production delays.
Yeah.
They had frustrated customers who were dealing with long wait times, and ultimately that led to a pretty sharp decline in their value. It really kind of highlights the importance of making sure that your growth is manageable and that it doesn't overextend your operational capabilities.
Yeah, it's almost like they got too big too fast.
Yeah, they became a victim of their own success in a way.
Yeah, right. And then all these problems started popping up.
And we can't forget about the inherent risks that are associated with high growth.
Yeah, that's true.
Companies that are pushing the boundaries, innovating, rapidly expanding aggressively, those companies are inherently riskier than those who are kind of playing it safe.
Right. And so how does that risk factor into like the equation when you're trying to value a company?
Yeah, it's reflected in how investors assess companies. So a higher perceived risk translates to a higher discount rate in valuation models. It's kind of like if you're lending money to a friend, right? And you think they're a really risky borrower, you're probably going to charge them a higher interest rate.
Yeah.
And the same principle kind of applies when you're investing in companies.
Right. So the riskier they are, the more return you're going to want as an investor.
Exactly. And this plays out differently in different industries.
Okay. How so?
Well, consider like biotech startups, for example. They have this potential for massive growth with groundbreaking research.
All right.
But at the same time, the failure rates of clinical trials are very high, so it makes them inherently risky.
Yeah, that's a good point.
So investors understand this, and they factor that risk into their valuations.
Okay, so it sounds like we've established that growth isn't always a straightforward path to higher value.
Right.
There's these pitfalls, nuances, and risks to think about.
Absolutely.
So how do we, as investors, or just anyone who's interested in business, how do we actually assess this relationship between growth and value in a way that's actually practical?
That's the key question, right? It's about looking beyond the hype and really understanding what's driving the growth of a company.
So what are like some tips or some red flags that we should be on the lookout for?
Well, first and foremost, I would say you want to look for sustainable growth.
Yeah.
And what I mean by that is growth that's coming from expanding into markets where the company has a real competitive advantage, where there's strong customer demand, and where they have the operational capacity to deliver on that growth.
Can you give me an example of a company that you think does a good job of this?
Sure. I think Apple's expansion into services is a good example. They've created this whole ecosystem around their hardware with things like iCloud, Apple Music, the App Store. All these services generate recurring revenue streams that complement their hardware sales.
Yeah.
And it creates a more sustainable growth engine.
So they didn't just try to grow in the same way they were before. They found new ways to grow.
Exactly. And another really important thing to understand is this trade-off between growth and cost, because growth often requires a lot of investment, marketing, research and development, new infrastructure, and so on. And while these investments can pay off, it's not always guaranteed.
So how do we know, like, if a company is doing a good job of managing this balance?
Well, you want to analyze how they're maintaining their profit margins while they're growing. Are they sacrificing profitability in order to expand really rapidly, or are they finding ways to grow more efficiently?
Okay.
Companies like Alphabet, which is Google's parent company, they've consistently maintained really strong profit margins while also investing very heavily in growth areas like cloud computing and artificial intelligence. So that's a sign of a well-managed growth strategy.
And I think it's also important to remember that those really high growth rates are really difficult to maintain as companies get bigger. Right? The bigger they get, the harder it is to keep growing at the same pace.
Absolutely. Microsoft is a really good example of this. Their early growth was just phenomenal, but as they evolved into this tech giant that they are, the growth naturally slowed down.
Right.
So what did they do? They adapted by shifting their focus to higher margin businesses like cloud computing.
Okay.
And this ensures that even more modest growth still contributes pretty significantly to their overall value.
So we've talked about the importance of sustainable growth, managing the cost of that growth, and the challenge of maintaining it as companies grow. But I think before we wrap up, it's important to reiterate that growth still does matter.
Yeah.
It's just not the only factor, but it is a key element.
Oh, absolutely.
In valuation, right?
The market tends to reward companies that demonstrate that consistent and sustainable growth, even if their current financials don't fully justify it.
Okay, so there's an element of future potential baked into that valuation.
Exactly. But there's also a flip side to that.
What's that?
The market is really, really quick to punish companies that don't meet those growth expectations.
Oh, yeah, we see that all the time with the earnings reports.
Absolutely. You know, a company that misses its growth targets can see a huge drop in its share price.
Right.
Even if the underlying business is still solid.
Yeah. So it really shows how important it is to look beyond just that growth rate and dig into how a company is achieving that growth and whether or not it's something that's going to be sustainable over the long haul.
Yeah, it's all about the quality of the growth, not just the quantity.
I think the big takeaway here is you can't just blindly chase growth. You really need to understand what's driving it.
Yeah.
And make sure that it's sustainable, or you could be in for a rude awakening.
Exactly. It's about making informed decisions, not just following the hype.
So let's recap some key takeaways for our listeners today.
Right.
I think first and foremost, we learned that growth alone isn't enough.
Right.
It's the quality of that growth, right?
Yeah, absolutely.
How sustainable it is, how profitable it is, that really makes the difference.
Investors need to be wary of those kind of overhyped narratives. You know, companies that are priced for perfection are bound to disappoint if they don't live up to those sky-high expectations. So always assess the risk along with the potential reward.
And it's important to remember that context is everything.
Yeah.
The relationship between growth and value is going to vary depending on the industry, the company's size, and the overall market conditions.
Yeah, there's no magic formula that applies universally.
And patience is key.
Absolutely.
But you also need a healthy dose of skepticism.
Oh, yeah.
When you're evaluating these growth stories.
Don't be afraid to question those unrealistic assumptions or overly optimistic projections.
I think those are all really, really valuable points. Now, before we wrap up, I want to leave our listeners with something to think about.
Okay.
We've talked about all these different companies and their approaches to growth. Think about a company that comes to mind for you. Maybe it's one you've invested in, one that you admire, or even one that's had a really dramatic rise or fall.
Right.
And as you think back on that company's journey, ask yourself, did their approach to growth ultimately create value, or did it destroy value?
That's a good question.
And what were the key factors that led to that outcome?
Yeah.
Hopefully this deep dive has given you some tools to start thinking about those questions and become a more informed investor and business thinker.
It's all about actively engaging with these concepts. The more you think about these dynamics, the better equipped you'll be to navigate the complexities of the business world.
Well, that wraps up our deep dive for today. We hope you gained some valuable insights and maybe even a few aha moments along the way.
Yeah.
Remember, growth is a powerful force, but it's not always a guaranteed path to success.
Right.
It's about understanding the nuances, asking the right questions, and making informed decisions.
Until next time, keep learning, keep questioning, and keep diving deep.
Thanks for joining us.